Okay, Dave, you ready to go?
That's good. Let's do it.
Cool, great. So welcome everybody. I am Brian Lieberman. I'm the COO of MLG Blockchain and the head of our capital group. With me today is Dave Miranek, who is our director of research, and we're very excited to present to you about an hour of deep dive information on tokenizing assets. Essentially, the idea of how our tokens going to represent all sorts of digital assets in the future. And so without further ado, I'm going to pass the mic over to Dave for a brief introduction of himself, and we'll dive right into it.
Thanks, Brian. Glad to be back here, and I hope everyone enjoyed their holidays. And once again, a big thank you to everyone who tuned in today. This webinar is a continuation and the second part of a series specifically designed to get all of you smart on investing in digital assets. Even since the last time we spoke in November, we've seen some exciting development, and we are all seriously excited to keep on sharing our insights with you. This webinar developed out of a growing demand from our clients to understand how assets are tokenized, why they should be tokenized, and the opportunities that exist as a result. If any listeners have future topics you would like us to help you get smarter on, we'd be happy to devote future sessions to those matters. On a high level, Brian, Michael Gord, Kyle Fry, myself, and the team at MLG fundamentally believe that blockchain is going to have a sizable impact on a variety of different industries. While many businesses are in the process of adoption and implementation, one place we've seen significant change is in capital markets and private securities. If there are 2 points that we want you to take away today, it's that, most of all, the power of tokenized assets is in unlocking the liquidity by removing barriers to trade in private global markets. The second is that there is no regulatory ambiguity here. These assets are considered private securities and are subject to securities laws. In fact, tokenized assets actually represent an opportunity for regulators to be proactive in compliance. So today, we're going to take you through a detailed introduction to tokenized assets, explain what they are, the difference between digitally native and non-native assets. We will then demonstrate on a high level how these assets are issued and programmed, with an emphasis on engineering and execution. Our next section will take you through why tokenization matters and why regulators may actually prefer the use of these assets, their role in unlocking value and providing liquidity, and how they invite financial inclusion, access, and participation. Our final topics will cover some interesting case studies we've seen through the tokenization of sporting franchises and real estate. And then lastly, we'll cover some glimpses of the future, where we'll see where are these assets headed, and we'll get to look at some really cool opportunities for financial products. So let's get at it. For those of you that are unaware, my name is Dave, and I'm the head of research and a partner at MLG Blockchain. I've been in the space for a number of years now, having been involved with the FinTech Club and the Scotiabank Digital Banking Lab at the Ivy Business School as president, while also working heavily with the Blockchain Education Network and the Blockchain Research Institute. But enough of that for now. So before we begin, just a reminder that while introductory, some of this content surrounding digital assets does look on it. So I suggest that if you haven't yet, you go out and give that one a listen. I believe they'll be posted on our YouTube page momentarily. Digital assets on a high level can be divided into 2 distinct subgroups. For the purposes of our discussion today, we're going to use the terms digitally native assets versus non-native. At its most basic level, the main difference between these categories comes from how they derive their value. Non-native assets are often representative of some sort of physical good and have been tokenized in order to facilitate distribution and unlock their liquidity. Their fungibility, or their ability to be traded for a similar good, is limited because it is hard to reconcile the differences in value. Think bartering. If I'm trading a token representative of crude oil in exchange for a token representative of a piece of art, we may have difficulty coming to an agreement in exchange. These assets are essentially tokenized assets. This is also where digitally native assets come into play, as they can primarily serve as this medium of exchange. Think Bitcoin, Litecoin, or Dash. Coins that we've assigned value based on their function, the number of people who use the network and also agree on its value, or their use in services, perhaps payments. For the majority of our discussions today, we're going to focus on the category on the right, and then loop back at the end to demonstrate how these definitions are becoming more and more blurred as we move forward into the future. So I want everyone listening to this presentation to remember this slide, because we'll come back to it. Because tokens can be representative of value, one of the primary assets that has been pushed to be tokenized are financial securities. These assets take the programmable characteristics of traditional tokens and code in the parameters of the investment contract, the rights of ownership, compliance rules with regulatory authorities, and any claim on profits that might be associated with that particular security. Yet, now that all of these features can be automated into the performance and life of the asset itself, these rules can be autonomously executed, which is something we'll get more into in a bit. The last point I want to make here is because blockchains and networked technology power these tokens, they now have the ability to be distributed and traded globally and instantaneously while maintaining their value. Pretty powerful stuff. So while financial securities have proven to be a great use case for tokenization, we have three main characteristics of assets that make them the most suitable for tokenization or can benefit the most off the value add of digital assets. Josh Stein from Harvard says that these assets that consume a high degree of capital, that are sensitive to the cost of capital, and that are relatively indifferent to the identity of the investor are most suited to tokenization. So, as we discussed earlier, securities have been seen to have been one of the greatest early benefactors to tokenization, particularly private securities, as they have not experienced the liquidity inherent in public markets. One area of private securities we see the most are shares in a private company. Here, we have the example of Robinhood, who had their shares purchased by security token issuer Swarm, who tokenized them and had them begin trading on secondary markets. Coinbase and Ripple have been announced as their next targets. Private securities are also commonly shares in a private real estate investment trust, or REIT. This has been accomplished in 2018 by Indiegogo's tokenization of St. Regis Resort in Aspen, Colorado, as well as Harbor's tokenization of the Hub at Columbia, luxury student housing at the University of South Carolina. Lastly, private securities can include a limited partner interest in the performance of a fund. Both Blockchain Capital with their BCAP token, as well as Spice Venture Capital, have successfully tokenized interests in their respective funds. However, like we mentioned, we do have other assets that have been shown to be uniquely suited for tokenization, a growing trend over the latter half of 2018. On a high level, this can include fine art, a movement championed by the newly formed Blockchain Art Collective. We have luxury goods, anything ranging from precious metals and gems to luxury cars, fine wine, and the like. Lastly, we have unique collectibles. Think establishing global markets for your dad's impressive baseball card collection. Similar to what eBay did, except with blockchains, we now have a way to fundamentally guarantee and verify the authenticity of these assets, erasing the potential for counterfeits, fakes, and copies. So how does this all work? On the technical side, we have a number of parties at work here. we have the exchange layer, or the marketplace for these assets. This includes players like Bank to the Future, Hyperion, Shares Post, and T0. Next, we have the exchange protocol this marketplace runs on. These protocols define the rules on how many of these exchanges operate. This can include notable players like 0x and Loopring. We also need some sort of governance to ensure that these assets are constantly compliant with securities laws across the course of their trading life. This is where notable compliance platforms and issuers like Harbor, Polymath, and Swarm apply their trade. Then lastly, we have the token and the token standard that is capturing the value of these assets, as well as the blockchain, like Ethereum, that this all runs on. So we've developed a case study here on Harbor, one of the most notable security token issuance platforms, to help you further understand the role compliance plays in the operation and execution of these trades. Harbor conducts their tokenized asset interests with what they like to call a platform plus a protocol, or a combination of a compliance platform with an underlying blockchain-based protocol. The platform itself serves a variety of functions. First, it's what we would all see if we were interacting with the platform. This interface helps onboard the investor from their perspective. And then lastly, again from the investor's perspective, it manages the initial flow of funds from the investor into the placement. For the company issuing the asset, it's the front end that manages all their legal documents. Think share structures, articles of incorporation, and ownership and cap tables. The next component of this system, the blockchain protocol, is integral because this is how control and compliance measures are placed on every trade throughout the course of the life of the asset. Here, we have a rough diagram of a secondary liquidity market. The two components, platform and protocol, need to work together here to ascertain the identities of the buyer and seller, or else Harbor or any issuance platform cannot comprehensively ensure compliance. On any marketplace, whether that be over-the-counter desks, crypto and security token exchanges, or bulletin boards, the compliance platform is the all-knowing oracle. When a tokenized security trades, it pings Harbor, checking for a variety of private securities, tax, and placement laws. Most notably, it checks the who, the what, and the where. Who the buyer and seller are, their KYC, are they accredited investors? Are they who they say they are? Do any red flags come up? The what includes what the trade should look like, or even what the cap table should look like. Rules on taxation, other securities laws, such as holding periods, and perhaps other corporate governance features. And then there are finally the rules on where they can trade. So think traders present in restricted geographies, regions, and jurisdictions. Secondary markets. If one or more of these issues is flagged, Harbor simply floats an error into the trade, and it never occurs. On a high level, think sending an email to the wrong address and getting a no reply receipt back. The email just bounces back. That easy. So on this next slide, we can see that all of these rules are ensured in the issuance of the asset itself, and then guaranteed over the course of its trading life. And this involves not only compliance features, but any sort of programmable feature like voting rights, dividends, and governance. So listen, it's great that blockchains allow us to do all of this stuff. But at the end of the day, why do we really care? What is the difference being made here? Well, first, let's establish a few things before we move into what this means for regulation. Something we want to make clear, mainly because there's a lot of misconception out there, is that there is no regulatory ambiguity surrounding these assets. These are private securities. Below, we have the 4 criteria that outline the Howey test. This is the litmus test for what constitutes an investment contract and a security. These assets can only be sold to accredited investors. These accredited investors meet certain requirements. These capital requirements are meant to demonstrate that these investors are both sophisticated and knowledgeable. Finally, many of these assets and capital raises conducted fall under exemptions under what is known as the Jobs Act, legislation designed by the Obama administration to kickstart markets after experiencing a slowdown. These exemptions are listed below. On a high level, they're designed to apply to a variety of offering types and companies while protecting investors. Regulation A applies towards US and Canadian businesses issuing under $50 million in equity securities. These are exempt from registry with the SEC. Regulation D outlines 2 rules, 506B and 506C, that state that unlimited funds can be raised only to accredited investors. However, there are differences with the quantity of investors and on advertising restrictions of the deal. Rule 144A outlines specific holding periods for these assets, while Regulation S enables procurement of investment from overseas and can be done in conjunction with Regulation D. So back to why all of this programmable compliance matters. And it fundamentally concerns the unique relationship between the law and technology. See, common law is a legal standard practiced in Canada, the United States, the United Kingdom, and Australia, among others. It is based on the principle of stare decisis. I likely butchered that one. Also known as legal precedent. Judgments in the courts are made based on the outcomes of past cases and then applied to the situation at hand. In this way, the law evolves by looking to the past to inform the future. This evolution is also painstakingly slow, and decisions and outcomes can take weeks and months. Even new legislation can span months and years before codification. Yet, in comparison to these sort of cumbersome and backward-looking processes, is technological innovation. And innovation really only pushes forward in one direction, and it's forward acceleration. Google's chief futurist and director of engineering, Ray Kurzweil, calls this the law of accelerating returns. This theory predicts the exponential growth of diverse forms of technological progress. Essentially, this is rapid technological acceleration in a variety of forms. Given this rapid technical acceleration in relation to how legal decisions progress, the law is frequently slow to develop frameworks that can adequately compensate for the speed of technological development. Think of the race to come up with rules surrounding liability on autonomous vehicles, as well as data privacy on the internet. All of these laws are incredibly reactive in nature. It might explain how it took years to come up with the application of securities laws on many digital assets, and this was based on the 1946 decision in the SEC versus Howey. I think we might have had some progress since then. However, due to the customizable and programmable characteristics of tokenized securities, regulators can actually use these assets as vehicles to enforce regulation proactively in the issuance of the token itself. While normal, standard legal contracts can be seen as agreements between a number of parties with certain agreed upon terms, their conditions can only be enforced externally by regulators, lawyers, courts, or in the event that parties actually hold up to their end of the bargain. In comparison, the defining feature of a smart contract deployed by a blockchain is a guarantee of execution. Contracts do not need to be enforced by some third-party authority. Their terms are coded into the contract itself. That way, when certain conditions are met, they are autonomously executed. What this means for tokenized securities is that as we demonstrated earlier with our case study of Harbor, securities law and legal terms can be essentially programmed into the issuance of the token itself to ensure that throughout the asset's life, it is constantly abiding by the rules. Other features such as voting rights and dividend payments can experience these same benefits. These rules form the backbone of popular security token standards. This progressive approach is in stark contrast to the backward-looking approach of the law, but represents an opportunity for regulators for once to get out in front of innovation. So, as we discussed, these proactively enforced measures can include everything from the who, what, and where governing a trade, as well as any applicable securities and tax laws. This is also customizable to suit the nature of each unique company. In fact, many private securities laws today are not even adhered to. Oftentimes, this enforcement only occurs when the rules have been breached, and then we have a mess of lawyers and regulators and courts that have to get involved in the aftermath. The benefit here is not only in being proactive, but in the cost, labor, and resource efficiencies for automated compliance. For example, most ownership and cap tables are kept on an Excel file somewhere in the offices of that company or perhaps in their attorney's office. If these rules are broken, most people might not even know or realize until a grievance comes about years down the line. And this is exactly what happened in the case of Dole Foods, registered in Delaware. Somehow, shareholders own 33% more shares than Dole Foods actually had on its cap table. Even stranger, every share certificate that shareholders owned were completely valid. The result was a mess of litigation that could have all been avoided if it were recorded using compliance protocols governed on the blockchain. Now, to be fair, not every single private securities laws can be proactively recorded. But let's not forget what a blockchain really is, a distributed ledger. Even if something goes wrong that is not enforced from issuance, regulators still have the ability to electronically look up the ledger's history and see where the infraction took place. This auditability, in addition to the proactive compliance, enforcement, and automated execution, is why we mentioned that we at MLG feel that this ability is of such magnitude that regulators may one day make it mandatory that any securities issuance occur on the blockchain. Rumor has it that some regulators are starting to agree. Now, let's focus on another reason tokenization fundamentally matters to these assets. And the answer is perhaps one of the most highly touted. It's asset liquidity. Now, I generally find liquidity to be a concept that's misunderstood. Liquidity is not how able to trade one is, and being illiquid is not being unable to trade. Liquidity is a measure of how costly it is to trade. This cost can represent anything from search costs, so the time and resources it took to find buyers in other markets, or perhaps even the opportunity cost, the difference between the price you received and the price you could have gotten had to bring greater demand and competition for your asset in another marketplace. This difference between what you received and what you could have gotten is what we like to call the illiquidity discount. Or on the flip side, so you're selling your asset in a market flush with demand and you were able to retrieve a higher price, it's what we like to call a liquidity premium. A point I want to make here is that blockchain technology, assets, and networks do not in and of themselves create liquidity for these assets. What they do is remove the barriers that prevent one from accessing these markets of buyers and sellers. Through network technology and blockchains, I now have the ability to syndicate buyers, sellers, and investment globally, and blockchains guarantee that the validity of this asset over trade, and these trades can now be transferred and settled and cleared in near real time. Oh, and by the way, because I can now access global demand, I now have price competition for my asset, so I get to sell at a premium. This is what is so transformative about the power of tokenized securities. However, these are actually not features that we haven't seen before. And aside from value verification, instantaneous clearing and settlement, we actually see these features every day. And it's present in public markets. Billions of shares trade every day on public markets. Because competition for these assets is present, because barriers to trade are low, because information is so dispersed. In theory, these assets are priced exactly as they should be, and markets are efficient. Buyers and sellers come to these markets every day because they know that they'll get a fair price for their assets, and they know liquidity is miles deep. All of these wonderful features of public markets occur because in reality, they have been developed for hundreds of years. The ecosystem is thriving. We have global stock exchanges, we have brokers, we have analysts who cover the performance of assets, we have online trading tools, and we have firms that develop new financial products, and it all exists in one big interconnected web. And then we have private markets, and private markets are the exact opposite of everything I have just described. Private securities laws are fundamentally complicated, and capital can only be raised by jumping through proverbial hoops. Despite growing technological prevalence in our society, private placement is still very much left in the previous century and conducted via faxes and paper-based processes. This wonderful public market ecosystem is also absent, with information asymmetry on private companies extraordinarily high, creating risk for potential buyers and sellers, slowing the movement of capital. And then finally, while emerging, large thriving private company marketplaces underpinned by network technology simply do not exist, meaning that without this collection of buyers and sellers, liquidity is pretty much non-existent. If you want to sell your shares in a private company, the cost of syndicating investment is brutally high, and you are likely going to accept this wonderful illiquidity discount, and that's if you even find a buyer at all. So why does this even matter? What if we just wait for companies to go public and we'll experience all the benefits of liquid public markets? Well, as we discussed in our previous webinar, and as you can see on the chart on the left, IPOs, or initial public offerings, are severely on the decline. While factors such as geopolitical risk, apprehension about giving up voting rights, and nervousness about giving up the long-term vision for short-term profit goals are definitely factors, the cost and the time and the resources to go public are the driving factors here. Due to regulation like Sarbanes-Oxley in 2002, going public has become a game that only the largest companies can afford. As we can see on our right, the market cap of companies that are listing is growing rapidly, essentially meaning that they have the resources to do so. These high costs are acting as deterrents, meaning that going public no longer makes sense for the company looking to do a $50 million raise. While I believe that in this chart, IPOs in 2018 weren't fully accounted for yet, I think we can all understand the picture of what's happening here. We have a declining public capital formation. On the other hand, we are seeing massive growth in the formation of private capital across a variety of industries. This is being driven by private equity and venture capital funds, among others. These firms have performed incredibly well over the last decade, allowing their assets under management to grow rapidly in turn. Yet despite the success, many firms' IRR, or internal rate of return, appear to be on a decline. As private capital grows, Unless firms are choosing to make an exit through an IPO, PE exits are more commonly found through a private sale, where sellers are forced to accept illiquidity discounts. In a world where sellers experience competitive demand for assets, we would likely see liquidity premiums boost these numbers. On this next slide, we can see firms looking to raise are recognizing these changes occurring in raising capital in public and private markets. As a result, many are seeing tokenized securities, and specifically offerings under Regulation D, as the new avenue to receive funding. As we can see on the chart, interest in these filings have grown massively over the course of 2018. Interestingly enough, the majority of these companies that have filed have been concentrated in California, also home to the world's largest tech hub in Silicon Valley. This coincides with trends present in the tech space, where some large firms are shying away from public markets with fear of giving up shareholder control in their businesses and perhaps compromising long-term vision. But private financial securities aren't the only place experiencing illiquid markets. Private assets we mentioned earlier, such as fine art, unique collectibles, and luxury goods, are also having these issues. The reality for many of these markets is that many of these physical goods are fairly expensive, removing potential pools of buyers. Compounding these limitations are the nature of the goods themselves. Many are large, fragile, and awkward, or all three. Depending on the item, its movement may require the accompaniment of security. Value between like goods is also incredibly hard to reconcile, and therefore trades between similar items are few and far between. As a result, we tend to see markets for these items develop in a local and siloed manner, forcing sellers to offload goods at illiquid discounts. Or, if the service of specialized dealers are required to bring them to a broader audience, large commissions are normally placed on top for connecting buyers and sellers, thus removing the liquidity premium for doing so. Given the limiting features present in these markets and what we know about digital assets' ability to capture value, distribute ownership title, and remove barriers in markets, there's a growing trend to tokenize the interests present in these assets. In fact, one area we saw a lot of traction was the world of fine art. In 2018, many breakthroughs were made in an attempt to tokenize these assets. Christie's New York, one of the world's leading auction houses, recorded art sales on the blockchain for the first time, while a blockchain-based auction house known as Portion was also launched. Several summits were held dedicated to the intersection of art and blockchains, most notably by Christie's New York once again. And lastly, a piece of art was tokenized for the first time. The piece in question is Andy Warhol's 14 small electric chairs. After 31.5% of the piece was sold for $5.6 million, it was announced that this was the first artwork with many more to come. But blockchains not only help facilitate the creation of markets, but they also serve as a way to verify the validity of the assets themselves. This has sparked the emergence of registries such as Artery, a platform seeking to certify the authenticity of art pieces and collectibles. Now, one of the defining features of these physical assets themselves is that not only do they hold their value incredibly well, but they also appreciate quite nicely. In late 2018, the Wall Street Journal published a piece on the best performing assets of 2018. And its outcome is likely not one that you'd expect, with art and fine wine ranking in the top honors. In a world where alpha is becoming increasingly harder to find in traditional markets, the tokenization of these assets is opening up new opportunity for investment. Using tokenized assets as vehicles of value transfer, we can ask ourselves the question, just how big is this market opportunity? The answer is one that is likely hard to define, and depends on a number of things, such as global regulation and the speed of adoption. However, even if over the next 10 years, tokenized assets only realize a small sliver of what we see in front of us, this sliver is enormous when considering the size of the global pie. So lastly, when outlining why we should care about these assets, I tend to like to talk about opportunities for global access to capital and participation in the financial system for investors and entrepreneurs alike. When initial coin offerings or the process of fundraising by tokenizing a participatory right or interest in a blockchain network came about, it was a profound thing for a variety of reasons. Mobile phones and network technology were seen as emancipatory for many and paved an avenue for both large-scale and global participation in the financial system by democratizing the tools of finance. From an investor's perspective, anyone with a small amount of capital could participate in financial markets using only their mobile phones, thus avoiding legacy banking systems that have long kept many shut out. From an entrepreneur's perspective, anyone with a bright idea could publish this opportunity on the internet and have people who believed in its potential compete to finance its development through the use of cryptocurrencies. In theory, these were all incredibly powerful ideas, but failed in a number of ways. Investors had no obligation to be paid back and had no protection. Market manipulation went rampant. Fake projects and scams saw the access to capital and rushed to the space, and many who participated were left with a bad taste in their mouth. The result was an industry-wide push to adhere to price and securities regulation with one caveat. Only investors who met the threshold for accredited investor status would be able to participate. While the introduction of regulation did limit access from this group of people, many of the features of tokenized securities still support this original ethos behind ICOs as an enabler of financial access and participation. Even with these limitations, notable tokenized security issuers like Swarm are seeking ways around them by pursuing exemptions under Regulation A+, designed to access the common investor. The point here is that we are seeing a growing sentiment present in the industry to have these standards lowered with the goal of greater financial participation. Even with current regulations surrounding tokenized securities, from a business owner, entrepreneur, or issuer's point of view, more capital can be accessed globally than ever before by removing the barriers to investors. So what does this mean? Well, currently, public marketplaces tend to operate in a very local and siloed manner. The reason in many ways is due to regionalized securities laws differing across the globe, acting as a deterrent to investment. However, with automated compliance, United States private securities laws can be enforced globally to any investor with a laptop as long as they meet certain criteria. While current private fundraising can also be syndicated out to relationships overseas, fundraisers are bound by these relationships. By establishing private securities secondary markets in international geographies, not only am I not bound by my relationships, investment is now also not limited to geography, but can be syndicated to capital pools who may have interest and be present in any region on the planet. The reduction of these barriers to private securities once again means that not only can investors be found quickly, but that actual ownership interest can be exchanged for investment over the blockchain in record time. Once investment is received, shares can be transferred immediately and autonomously executed. This drastically speeds up the process of deal execution. Lastly, the removal of search costs and financial intermediaries in the process mean deal procurement and execution comes at a much lower cost of capital and can be done at a drastically reduced price. Now, From an investor's point of view, not only do they experience liquidity for their assets, as was mentioned earlier, but they now have access to quality investments globally alongside quality investors, owners, and management teams. Much of this can be established due to fractionalized token ownership. Let me explain. We'll show you a rough example here. Say we have an investment order in front of us here for 45% of a high growth private tech firm being issued on Swarm, Hyperion, Harbor, or any other issuance platform. Two large funds that are notable for savvy investments have already taken the lead on investment. Other accredited investors can now recognize this and have the opportunity to invest alongside these quality investors, fill the remainder of the order, and using these platforms have access to projects from anywhere in the world. All they need is a laptop. Never before have individual and accredited investors had this opportunity to invest alongside these large firms with reputable reputations and from any locale. Recently, a new firm known as DX.Exchange has announced it will go live this week and offer tokenized shares in Apple, Facebook, and Tesla, among 10 other NASDAQ-listed companies with plans to expand to the New York Stock Exchange, Tokyo, and Hong Kong. The shares were purchased by MPS Marketplace Securities, with a digital representation being issued on a one-to-one basis for each share, with owners being entitled to cash dividends, even though these companies themselves weren't involved. Additional shares will also be available for purchase on the DX exchange. What's so interesting with this particular case is that DX is internationally based, with offices in Estonia and Israel. Therefore, these assets are designed to give foreign investors access to US shares that they may otherwise struggle to buy. Not only that, but these tokenized securities will be able to be traded 24/7 and won't cease trading when North American markets close for the day. It's also important to note that these actions are completely compliant with US securities laws. Instances like these demonstrate how tokenized shares are permitting financial access on a global scale. Nevertheless, despite the strong case for asset tokenization, this does not mean that there aren't any pressing issues in the development of this ecosystem. First is the simple issue of information asymmetry. Currently, public markets are so efficient and information dissemination is so widespread that by the time you go to make a trade on information you've learned about a stock, it's likely already baked into the price and there is no value to be had. Alpha is tough to find in this manner. However, in private markets, we once again experience the opposite. Adequate information to make sound and prudent investment decisions for private companies are hard to come across. While some issuance platforms may enlighten investors with documents to help facilitate initial placement, if the token trades elsewhere, investors on secondary markets likely won't experience the same access. In Chris Berniski and Jack Tatar's book, Crypto Assets, the authors discuss what they like to call the Berniski-Tatar law, essentially stating that without adequate information disclosure, investment shouldn't or won't occur. This is a fundamental problem with the emergence of tokenized securities, as what essentially is being offered is private market disclosure with public market liquidity. Yet, there are also two silver linings to this dichotomy. The first is that ideally, in order to maintain token price on secondary markets, we may see private companies attempting to be more transparent with investors and providing a higher degree of disclosure. At MLG, we advise folks that conducting this type of fundraise is not a one-time disclosure. Without required reporting rules, firms should be prepared to keep the public informed after initial placement in order to maintain investor confidence. The second silver lining is that often with information asymmetry actually comes a much greater opportunity for value capture, arbitrage, and alpha. These gaps could have investors flocking to markets, helping quell other concerns present over demand. The second commonly cited criticism of emerging tokenized securities markets is the lack of marketplace infrastructure. And this concern is not misplaced. If I were to issue and list a security token right now, there wouldn't be many places for it to compliantly trade. So much so for an industry touting liquidity as one of its primary assets. Yet, in order for truly liquid markets to occur, we require more than just buyers and sellers. Industry-wide, we need issuance platforms for compliance, custody solutions for digital asset security and storage, and investment dealers to connect investors to projects that need capital. And lastly, then we need the secondary markets for buyers and sellers. If we continue, we need miners to verify blockchain transactions, funds for institutional capital, brokers to facilitate investment, and regulators to prevent nefarious market behavior. In the context of a single firm, they need to have developed working technology to work with every day, internal compliance officers and attorneys to make sure no one steps over the line, educated talent to round out their staff and personnel, and lastly, a network of relationships to support business development. And then, once everyone has their individual ducks in a row, we need to compel these stakeholders to coordinate and work together in an ecosystem where actors lend their efforts to one another for growth and development. The reality here is that public markets have experienced the benefit of hundreds of years of development to set our expectations. But if you really think about it, tokenized securities were barely being registered on people's radar 24 months ago. If you observe this small snapshot of a large group of stakeholders we have just demonstrated in the last few slides, and then focus your attention on the firms on the upper right seeking to enter the ring, in addition to firms such as Goldman Sachs, Overstock, and the Intercontinental Exchange, who have all recently been tied to tokenized securities and digital assets, you might begin to see adoption curves that look like this. Bill Gates has a quote that gets thrown around a lot in this industry by advocates like Anthony Pompliano, but it is perfectly applicable for this situation. He says, "We always overestimate the change that will occur in 2 years and underestimate the change that will occur in the next 10. Don't let yourself be lulled into inaction." At MLG, this is how we feel about the state of tokenized securities and what's to come in this industry. This technology will have a profound effect on private markets. Look how far we've come in such a short time. And for those looking for alpha, it is much better to be early than late. As Gates says, don't let yourself be lulled into inaction. Now, the last criticism I want to bring up that is frequently directed at tokenization is aimed at demand. The argument goes that just because these assets are now tokenized, how does that change or alter the demand for them? However, there are a couple layers to this. The first point goes back to a discussion on information asymmetry and the opportunities it creates. As alpha becomes harder and harder to extract in other markets, I do believe that there will be a growing interest in the opportunities present in private securities. The next point here is that I believe demand will also very much mirror the adoption curves we saw in the past slide, and demand will also follow the process that we've outlined below. Investors need to be educated on the industry and opportunity, the technology, its usability, proper custodial and storage solutions all need to develop. Investors also need to realize that these are private securities, and regulatory risk is mitigated if you play within the rules of the game. This could become a larger component also if accredited investor standards find themselves lowered by regulators in the future. Lastly, as long as tokenization is led by strong projects with experienced management teams that represent solid investment opportunities with potential, then investors will be incentivized to invest and reinvest. So, as I just mentioned, the push into tokenization needs to be led by quality assets with investment potential. But not only that, these assets also likely have to have a clear, defined need for tokenization. And this is where the possibilities of tokenization start to become really fun for me. Because the reality is, the sports franchises are a prime candidate to have shares tokenized. If we remember the beginning of our presentation, we established 3 key criteria for assets that would benefit from tokenized shares. Assets that consume a lot of capital, assets that are sensitive to the cost of capital, and assets that are indifferent to the identity of investors. Not only do sports franchises tick all of these boxes, but they make a clear case based on other criteria we just mentioned as well. A well-known criticism in the emergence of private tokenized securities is the lack of info on some private companies. Yet, professional sports franchises are some of the most analyzed entities in the world. The emergence of fantasy sports, as well as national and local media coverage, all make personnel decisions, lineup choices, roster moves, player injuries, and advanced stats public knowledge. And athletic performance is actually directly tied to financial success, as winning leads to playoff berths, which are lucrative sources of additional revenue. If you don't make the playoffs, you don't get that revenue. In addition, financial metrics such as player and coaches' salaries, sponsorship and broadcast deals, and franchise enterprise value are also commonly found. In terms of providing access, professional sports franchises are some of the hardest assets to gain ownership of, while frequently cited concerns of asset demand are also eased by rabid fans who often make purchasing decisions with their hearts rather than their heads. And that's not to say that sporting franchises aren't prudent investment decisions. A clear case can actually be made in European football, where many of these clubs are publicly traded and have financial information open to the public. These franchises also typically receive consistent ticket sales. Strong merchandise revenue is buoyed by sports' biggest and most marketable stars. And perhaps most importantly, incredibly lucrative international and local broadcast TV deals, which can facilitate further deals for team sponsorship. Even in the National Hockey League, the smallest of North America's four major professional sports organizations, the value of an expansion franchise grew 30% over a 2-year period. So given this consistent success, why does tokenization matter, and why would owners give up minority interest, if any? This is primarily because player salaries, maintenance and operational fees, local social programs, coupled with high expectations, lead to the consumption of an extraordinary amount of capital. This cost of capital becomes even more sensitive when stadiums age and need renovation or reconstruction. While owners are typically very wealthy, billion-dollar stadiums can cause even the richest to reach deep in their pockets. In the event this is unmanageable, municipalities are often asked to bear the burden or be threatened with relocation. And there's a lot of evidence to suggest that large-scale arena projects don't always deliver the economic benefits suggested to city councils, but is rather retained by the team and their shareholders. Yet, with fans as both the owners and benefactors of tokenized shares, instances like the Green Bay Packers, who sold common shares to the city of Green Bay, have proven to be successful with the franchise and its home. Green Bay was able to continue to thrive, renovate their stadium, despite being the smallest sports market in North America. So how would this work? Well, we can look at a team in need of stadium upgrades, for example, the Toronto Blue Jays. Or perhaps even consider the possibility of Toronto buying a few years of a big-name free agent like Bryce Harper. Investors who bought into the hypothetical $135 million round of tokenized shares could be faced with a variety of exciting options. Through smart contracts, investors into a funding round for a stadium could receive a right to luxury boxes, seats in the stadium, or even a claim on merchandise, sponsorship, or broadcast revenue. And this is pretty lucrative. Shares can also give fans potential input on large-scale decisions affecting the league. If a team signed a big star that led to a playoff performance, perhaps that they could receive the windfalls from playoff games. And lastly, as professional sports gambling grows and gets league support after legalization, shareholders could be entitled to profits from this coming gold mine as well, and even present or possess the ability to place longs and shorts on the athletic product itself. Imagine going long on your team making the playoffs and experiencing dividends from postseason games. Even greater emphasis would be placed on player analytics and accurate injury reports. Real estate is another example of a candidate for tokenization. In fact, much of the current demand for tokenization is coming from these assets. Once again, as you remember our criteria, real estate consumes a ton of capital in development. It is relatively sensitive to the cost of capital, as there are costs in following the complicated rules of syndicating investment for a private REIT. And lastly, REITs are mostly indifferent to the identity of investors as long as they meet accredited investor laws. Yet, some private real estate investment trusts or REIT structures have come under fire from Forbes, citing private REITs as poor investing decisions. On the surface, the performance of private REITs severely have outproven these claims. As we can see on our right, even through economic downturn in 2008, private REITs have performed admirably well. The reason for this is that many REITs are formed around apartments and commercial projects that are seen as recession-proof, unnecessary housing. Look no further than Harbor and Convexity Properties 2018 tokenized REIT, or T-REIT, called the Hub at Columbia, a luxury student housing initiative at the University of South Carolina. Investors in the T-REIT were offered access to a $20 million round for a 49% stake in the building under Regulation 506B. The benefit is that they are now able to raise this high degree of capital without losing majority control and the management of the asset. While luxury student housing is often seen as one of the most recession-proof real estate assets on the market, as even in recession, students still need to go to school and will require housing. Once again, we can see how the positive performance of a private apartment index against a number of global macroeconomic events. So why do we have this criticism? What is Forbes trying to say? Well, Forbes' criticism stems from a number of complaints beginning with information asymmetry and a lack of transparency. They state that it is not always clear from an investor's perspective what specific real estate may be the target of the fund. And in addition, with limited reporting requirements, some private REITs may charge high hidden fees or excessive commissions. Further detriments include an inability to liquidate positions without accepting discounts, as well as from the issuer's end, an incredibly complicated rule structure to adhere to private securities laws, as well as ones governing private REITs in particular. This makes setting up private REITs and syndicating investment particularly challenging, as the rules are quite specific. Private REITs need a minimum of 100 investors for tax purposes and cannot have more than 1,999, or it must go public. In addition, non-US persons have to own less than 50% for tax purposes, as well as the top 5 shareholders have to own 50% for tax purposes. There are also holding periods, specific rules for affiliates and control persons, and all of these factors make managing the cap table or fund structure a headache to deal with. Mixing the fact that private securities are still very much governed by inefficient processes that haven't quite migrated over to new technologies. And you can see why emerging REITs are looking at automated cap tables as a way to significantly streamline setup and management processes, especially during tax season. This reduces the cost of operations by a significant margin, allowing more value to be returned to shareholders. In addition to this, from a shareholder's perspective, the ability to liquidate not only allows current shareholders to receive a fair price for their interest, but also gives new potential investors the ability to have access to these opportunities. Lastly, in order to maintain share price, REIT managers will likely be more transparent with reporting and potential fees to incentivize new buyers. So sticking with the topic of real estate as an example, we see some massive opportunity for new financial products. Using these new products, we also see interesting opportunities for portfolio diversification. Using smart contracts, different classes of shares can be offered to investors who may have different appetites for investing. One class of shares could deliver a percentage of rental income similar to a preferred share if investors are looking for consistent revenue streams. Similarly, if investors see a hot housing market, they may want the class of shares that delivers price appreciation of the asset. In the same vein, we could take classes of fractionalized shares from a bunch of tokenized buildings in large metropolitan cities like New York, wrap them up, and create an exchange-traded fund, or ETF, that is representative of building values in a specific area. One could go, in theory, short Brooklyn or go long on Southeast Manhattan. This ability becomes particularly important if you consider the new developments in cities. For example, here in Toronto, Microsoft just announced the opening of a new large headquarters in the South Core. Imagine being armed with this information, taking a long position on the South Core, a building they plan to occupy, or the property they plan to build out. The potential outcomes here are endless. Well, right now, we're seeing many companies pool their capital into a holdings firm and issue digital shares that reciprocate the number of paper certificates. So essentially taking existing equity and putting on the blockchain. This action is actually similar to just what we saw at the beginning of the internet, and taking news, creating a digital copy or a PDF version, and capitalizing on digital distribution. But the companies who really captured the value of the internet were not the companies who simply did just this. It was the ones who recognized the value of data analytics, seeing user preferences, understanding their behavior, providing them with a user experience that scientifically we know they want, and pursuing user-generated content that goes on and on. Once we see companies not just migrate existing equity structures, but actually issue them on the blockchain, we believe that this is where we'll see the development of possibilities that we likely cannot even fathom yet. MLG Blockchain is a global venture creation and advisory firm with blockchain technology development and broker-dealer capabilities. We at MLG are completely immersed in this stuff every day. We constantly have our ears to the ground listening for emerging trends. We have global reach and work with some of the best in the business. We also have a team that has vast experience in both blockchain and crypto and in financial markets. We're also a completely compliant firm that ensures investors in issuing companies are protected. We also have a variety of core competencies and offerings to best serve our clients. And finally, we are looking to provide you, the investors, the tools to successfully navigate this space and the key considerations that we are on the lookout for daily. Our aim at MLG is to significantly speed up your understanding of digital assets and their markets and put you in a position to succeed. This concludes our presentation. I want to thank you all again for taking the time out of your days to come and learn about this fascinating and rapidly growing industry. We're here to take all of your questions, comments, and concerns, and look forward to learning and growing with all of you. Thanks a lot for your time, guys.
Wow, Dave, awesome stuff. Well, thanks everybody for sticking around. Hope you enjoyed the afternoon with us. Looking forward to having another webinar come mid-February, so send some updates on those as we finalize the topics. And if you have any questions, please feel free to email us at capital@MLG Blockchain or at the below. So Brian at MLG Blockchain, Rashid at MLG Blockchain, or Dave at MLG Blockchain. We'll be happy to answer any questions you may have. Thanks a lot for tuning in, and have a great day, everybody.